I'm very, very pleased. Ron got a big shout out in the first panel. So he got a pre-introduction from Ed, and I'm going to try and build on that. I mean, first just to go over the biographical details, which really don't need any introduction. Ron was the CEO of Public Storage, which is the United States' and I think it's the world's largest self-storage company from 2002 to 2018. Ron joined PSA in 1986. And since his retirement as CEO, he's been chair of PSA. Let me just pick up, Ron, on where Ed started. I mean, Public Storage was a visionary company, virtually creating a category. Tell us a little bit about, the thought process behind that, working with Wayne Hughes, the founder, the whole kind of the Public Storage story.
Sure. Well, Ed's very generous to think that we knew what the hell was going to happen. Okay, we had no idea. The Public Storage started in 1972. Two guys started it, $50,000, and the idea was to a land bank. We're going to put this garage space on land, generally secondary, tertiary locations of land, and rent these garage spaces. And the company was originally named Private Storage. And when we couldn't get people to come to the properties, we asked them why, customer survey, and they said, well, it says private. So we changed the name to Public. Okay, and what happened is we were building these things, and there was no one else to manage them because there was no property management companies to do self-storage, so we built a management company. And then once you get into management, you need scale and market share and all that. So we continued to do that, and then we started raising money in limited partnerships. And they were all cash limited partnerships because in 1979, 1980, interest rates were 18, 20%, and we couldn't get any financing. So we did all cash deals. And we did that through the kind of the 80s until the syndication business and the savings and loans blew up. And then we converted all those partnerships into REITs and then merged them into one company, which is today Storage Equities, which we did in 1995. The other thing that we learned along the way is that REITs have limited ability to retain cash flow. They have to distribute 90% of their taxable income. So since with $2 billion of assets and only $200 million of debt, we nearly brought ourselves to bankruptcy. We decided we're going to find a different form of financing, and in 1991 we issued the first preferred stock, perpetual preferred stock of a REIT. And we did only preferred stocks until 2014 when we did our first unsecured bond deal. And we did that in part because the preferred market is not very deep, and the corporate bond market, especially if you're investment grade, is much deeper. So where are we today? Well, we have 2,000 plus of these facilities. We're in 35, 38 states. We have 6,000 plus employees, 200 million square feet, and 1.5 million customers. And it's been a hell of a ride. It's been a great performing business. If you look over 20 years, this and manufactured housing are kind of the two best food groups of real estate. I would say, given inflation, it's month-to-month leases, but people come in and stay 3 years. They never expect to stay 3 years, but they on average stay 3 years. We can reprice the leases every month if we want, so it's a great inflation hedge. And we've, used conservative financing with preferred stock. We have about $4.5 billion outstanding and $6 billion of debt on a $55 billion plus equity market cap.
Go back to what you started with, Ron. You said it was a land bank company, so you were just putting these parking garages or garage storage spaces on the land because you thought you were going to do something else with the land eventually?
Yeah, that's a good question. We thought that at some day we would, convert it to, someone would come in and buy it and convert it to office or apartments or retail. Well, we just heard the skinny on office and retail, right? So it turns out the cash flow per foot has outpaced all of those alternative uses, even apartments. And so we went from kind of secondary locations to primary locations to retail locations to infill locations, and it's evolved much more into a retail. Where's the growth going? How can we get on a corner so we have brand visibility, et cetera, et cetera. So we've moved away from just pure land banking to, okay, where's growth happening in the country? What are the demographics? We've been big in Florida and Texas the last 15 years. So where are the things going? Where's the growth going? And we want properties in those locations on high quality sites.
One of the things we talk about here at this conference quite a lot is, what the REIT trajectory is in a particular property type. Self-storage is relatively unREITed. And do you see that changing? What's the dynamic that drives that?
Well, it doesn't take a rocket science to build a self-storage property, okay? I mean, it's pretty, roll-up garage doors. It's not complex. So it's a very entrepreneurial, relatively on outfill areas, easy to build, easy to operate, and it's easy to operate a couple of them. It's pretty hard to operate 2,000 of them. If you take, so the industry as a whole is like 50,000 or so plus units, and it's maybe gone from 45 to 50,000 over the last couple of years. The REITs 25 years ago had 5% of the market. Today they have about 15% of the market, and I would see continued consolidation of that over the next 20 plus years. And we do the greatest number of transactions we do are 1 and 2 property deals. We do occasional 50 property deals, but the greatest number is 1 and 2 property deals.
You said it's easy to operate a couple of self-storage facilities and it's hard to do 2,000, but I think you're adding a lot of value in managing the 2,000 that the mom and pop are not doing on the 2.
Correct. Yes, our margins are 82%, and maybe a mom and pop is 65%. But even at 65, it's a great business, and they can still make plenty of money. And for this business, contrasted to office, there's no tenant improvements. There's no broker commissions. I mean, you roll up the door, sweep out the space, maybe change the light bulb, and it's ready for the next guy. Okay, so it's a very low capital intensive business, which is why it's such a great business. I said this one time, it pukes cash. I mean, it just pukes cash. So it's just a great business.
What about, we talked again, everybody's talking all the time, AI. I mean, what about the technology that goes into the whole customer relationship, the pricing, acquisition? I assume that's changed a lot since the land bank days.
Yeah, in the beginning, we used to hire retired military couples and go down to the pound and get a dog, and that was a security for the property. Okay, so it's evolved since then. Having 6,000 employees, 2,000 locations, 1.5 million customers, our business is ripe for technology. One of the things that happened with COVID, we were piloting a concept called e-rental, where you could do a lease online and not have to come into the property. Well, with COVID, we rapidly rolled that out, and now 50% of our business is e-rental. So the customers do it online, give us a credit card, and show up to your property and roll up the door, and inside unit 142 is your lock, your lease agreement, your insurance agreement, and you never talk to the property manager. We give you the gate access code, and you go right into the property. So that's been a huge plus. We estimate that's going to reduce, or has reduced, our labor hours by about 25% at the property level, which is huge.
Big difference.
We've automated our gates on a centralized basis. So we have centralized control with our gate systems on 2,000 properties. So the other thing we've done is create an app, the public storage app. So once you become a customer, you download the app and you can get into the property without talking to the property manager. You just hold up your phone and the gate unlocks, and you can take,
Nope.
do things that way. And incredible adoption of the app. Again, that's taking away from high touch points that the property manager and the relief manager used to do. It's automated, so our hours needed at the property have come down, and I imagine they will continue to come down. That's also part of the benefit of having scale in markets, is you can have managers do multiple properties and not just one property, one manager.
Let me change the topic a little bit. You've sort of, as part of the public storage story, the PSA, the ticker symbol, you've spawned some M&A activity and some other companies. Let me start with maybe PSB. PS Business Parks was a company that was created out of public storage. Maybe to start at the beginning, give us a little.
Sure.
What happened? Where did PSB come from?
Well, when we were raising money in these partnerships in the 80s, we ended up owning about 3 or 4 million square feet of flex industrial space and a couple of office properties. And so when we merged the private company into the public company in 95, we set up an entity, today is a thing called PS Business Parks, and then we took that public in 1998 in a reverse merger. And that grew for nearly 25 years, 22 years. And then in 2021, Blackstone approached us about buying PS Business Parks. Took about a year and a half. Great law firm, Wachtell, Adam. And we signed the agreement, I think, in April of 22. Despite the war in Ukraine, despite the CMBS market imploding, despite the bond market imploding, Blackstone came through, consummated the transaction in 22, and the transaction closed in July of 22.
And what was the logic of having PSB go private at that time? Just that Blackstone has all the capital in the world, needs to buy everything, or what was the story there?
You got Nadeem coming up next, so you can ask him about that. It was just what I viewed as a fair trade. It wasn't the highest possible price we could have waited for, but I thought it was a fair trade. We'd been through 4 CEOs in 3 years for a variety of reasons, and I just thought it was a good time, good trade for the Public Storage Organization. The other company that we spun out is SureGuard, which we acquired in 2006 with the merger of our second largest competitor, SureGuard, here in the U.S., but they also had a European operation. We didn't know anything about Europe, so we were a little scared of that, but we grew that, and then we took that public in October of 2018. And so that's a separately listed company on the Euronext in Europe, and it's the largest self-storage company in Europe with almost 300 properties, which doesn't sound like very much compared to the 2,000, but there's only about 1,800 properties in all of Western Europe of self-storage. So it's a much underdeveloped industry in Europe than it is here in the U.S.
Do you see that changing, or America is just sort of a unique, different market?
The customer behavior in Europe is as good or better as it is in the U.S. But the capital markets, the banking systems in Europe are very different than they are in the U.S. And therefore the development process, the ability of capital to flow into that is much more challenging in Europe than it is in the U.S. I mean, there's guys building self-storage properties, but it's almost like the moms and pops here. I don't see it getting to the size of the U.S., but to give you an idea, I think in Paris there's 150, maybe 200 properties. If you did the same density as LA, which they're about the same geography, same population, you could handle 1,500 properties in Paris. Okay, so, and the same goes for the major metro centers in Europe. They're just way underdeveloped in terms of storage per capita.
Going back to PSB for a sec, aside from this nice remark about the right lawyers and so forth, what lessons in deal making did you take from that?
Well, we were not out marketing PSB. So when Blackstone approached us, there was not a full-on marketing process. until we had the contract signed with Blackstone, and then for fiduciary reasons, we had to do a 30 or 45 day, can someone beat that bid process. I think the best thing, the biggest takeaway was you got the right person, the right entity to sell to that, yeah, you have to have contracts and all that, but if you shake their hand and look them in the eye and they say they're going to do the deal and you're dealing with a high integrity person, that's the most important thing. And it doesn't matter whether you're buying or selling, it's the same side. What's the organization that you're dealing with? And Blackstone has a very good reputation, and they had, as you know, Adam, they had plenty of reasons to go, stop, the Ukraine's been invaded, the CMBS market's closed, but they didn't. They closed the transaction.
Thanks. That's interesting. What about the current year? Obviously, you think that conditions are now worse. Is the M&A market likely to be slower in this year? We've heard a lot before, obviously, about as Mike Graziano said, when your value goes down by half, you don't buy and sell. Are we now in that even worse sort of phase of things as far as transacting?
I think for the REITs, they are finally at a competitive advantage to private equity. The CMBS market is still turmoil. Non-investment grade bonds are still in turmoil. And REITs have a currency, their stock. I disagree with a little bit of the discussion of I'm selling below NAV or above NAV. NAV is just what's your NOI and pick your interest rate, your capitalization rate. That's all NAV is. If my stock is selling at 12 times earnings and I can buy your company at 8 times earnings, I'm going to do that trade. Yeah. Okay? And I don't care what someone says my NAV is 20 times earnings. I don't care. I'm at that arbitrage, I'm doing the trade. And I think that's a little bit about what Ed was saying. Is like, okay, well, if I can create all this value and issue stock, I'm going to do that, and it's going to show up in the cash flows, and sooner or later, the NAV guys will catch on to it. It just works its way into the cash flows. So I think the REITs, up until, last year, really, the REITs have been at a disadvantage for the past decade. Interest rates have come down. The bond markets have been very, exuberant is the right word. Lower spreads, lower rates, and plentiful leverage. That created a disadvantage for the REITs in terms of really doing some transactions. So I think there'll be things that are out there in terms of arbitrage and multiples that will give the REITs an advantage for the first time.
We talked a bunch this morning about predictions as well, in comparison with the great financial crisis, the pandemic. What, are you bullish? Are you cautious? What are you thinking about the next 12, 24 months?
I don't know, so I'm going to start with that. But I think we're in a period of what Warren Buffett calls the tide is going out, and we're finding out who doesn't have swimsuits. Okay, and we've seen it with the SPACs. We've seen it with crypto. I guess we saw it with Credit Suisse. We may be seeing it in office, but there's been a lot of liquidity, a lot of leverage put in the system. You don't know where all the bodies are buried, and I think we still have some more time for the tide to go out and find out who doesn't, where the holes are. Sort
of consistent with the keep your powder dry, there may be good opportunities coming.
At Public Storage, it's to paraphrase Jeremy Diamond, it's fortress balance sheet, fortress balance sheet, fortress balance sheet. Even when there's lots of liquidity, fortress balance sheet, because we don't know what's going to happen, and you're right, we do want to be prepared for opportunity, whether it's downside protection or getting aggressive and going after something.
I want to invite Robin and Mark Norman up. We have a surprise here for you on the table. Come on, guys. Ron, we're proud to present you with this award, the REIT Visionary Award for 2023. We billed you as a keynote, so I wanted to sneak up on you and present this to you. Ron has had an unbelievable career and is still at the midpoint, but there's really no more deserving person in the REIT universe and the REIT leadership world than Ron to get this 2023 NYU REIT Visionary Award.
Thank you, Adam. Thank you, Mark. Thank you, Robin. Appreciate it.